Independence Day to each and every one of us, and standard disclaimers in place to start with. Purely an educational session. Always take whatever being discussed as a starting point. Due diligence and all the decisions should be purely yours, and we do not advise you to jump on any business discussions. You can certainly make big losses until unless you do your due diligence. And we'll be discussing primarily in the form of monologue initially, wherein we take views of Sajal sir and Aditya bhai on the sectors and maybe the earnings for this quarter. And after that, if time allows, and there would be relevant questions around good set of questions, maybe deep inside if you have studied any businesses or maybe some related questions, and follow up if there are any, rather than simply plain vanilla asking about company ABC and XYZ. That would not be entertained like always. So with that note, I hand it over to Sajal sir and Aditya bhai. I mean, any sequence we can start maybe.
Go for it, Sajal
No,
bhai.
yeah, sure, no problem. So, yeah, standard disclaimer. I'm not here to tell you or advise you what to do or what not to do. I'm gonna share my current opinion, which these days changes daily, sometimes minute by minute, given the extreme randomness. So, whatever I'm sharing, and probably um, both of us, me and Aditya, is subject to huge volatility, if you like it. And so don't take this opinion as your gospel or a basis to make any sort of financial decisions. And that said, given the topic, we got to focus more on the sectors rather than, asking stock specific questions if possible. And when it comes to sector, no sector is inherently good or bad. It's always the people behind the business who make all the real difference. And as investors, our job is to read those people carefully and invest less amount or allocate less as a percentage when our confidence and conviction score is below average. And everyone must have their own sort of threshold, what is acceptable when it comes to the quality of people, and bet big or disproportionately above average when we do find a rare mix of talent, integrity, and energy, because this is the rare breed. And I've said this before, and I'll just say this again, that parsing management is like crafting a meaningful sentence, whereas the ratios and valuations are just the alphabets. And without understanding the management, you won't know which letters or numbers matter, right? So you can't even create the sentence or parse the management. And these rare breed of high quality people, and the reason we prefer them is because they reduce the downside risk of randomness, and at the same time they amplify the long term upside. And success, as you would agree, and we have got umpteen number of examples, success comes from time, time invested find, combined with the partnership with the right set of people. And parsing management, I appreciate, is a lot more complex than parsing a balance sheet or a cash flow statement. And maybe if I can take the liberty without naming the company, I mean, there is a large Indian company with global institutions owning over 30% equity, and it's a large market cap. The market cap has grown significantly over the years, so you might assume that the management is top notch, right? And because after all, the numbers speak. But here is an unknown and unseen fact that multiple workers died in their factory, and not even an FIR was filed. Not even an FIR was filed. No investigation. Case closed. I mean, that's the reality of their ethics. I mean, what more proof do you need? So again, numbers lie. Often long-term performance may also lie, and we have to do our due diligence independent of whatever the noise is, whether the noise is positive about a business or the noise is negative about a business. And it's not an easy job to parse. And someone, luckily, I'm not invested in this business, but given this discovery, had I been invested in this business, would I have liquidated all my holdings? The answer is a vehement yes. So that said, I will stop there, and I'll pass the baton over to Aditya, and then we can take the Q&A.
Thank you, Sajal bhai, and good evening, everyone. Thank you for taking time out. My 2 cents would be simply that, first of all, the disclaimer. So I am an asset manager with a fund manager with Intellect Asset Management. So whatever I say, whichever company name I take, if I take, you should assume that we have vested interest. You should assume that it's not a buy-sell recommendation. It is just, for discussion and educational purposes. Always consult your financial advisor before you make investments so that you have the best outcome possible. Coming to how I see the market, so in my sense, the days of passive investing, making returns from investing in large cap or investing or making returns by investing in passive index funds, those days are behind. If you look at the 25-year-old history of Nifty 50, the PE multiple that Nifty 50 on an average trades at is 18-19 times, while the earning growth is around 13 to 14%. Historically speaking, the average earning growth is 13-14%. So you are looking at an average PEG ratio of historically at 1.5x, right? PEG is basically PE divided by growth. So PE being 18 to 19 and earning growth being 13 to 14. The average PEG of history of Nifty 50 is around 1.5. Today, as we speak, Nifty is trading at 20 to 23 times PE multiple, and the earning growth expected out of Nifty is around 9 to 10%. So you are looking at a PEG ratio of around 2.2 compared to historical average of 1.5. So that's almost a 50% premium to historical PEG multiples. So clearly, if not a euphoric zone, at least an overpriced zone for sure. And we have already seen past 15-16 months Nifty returns are zero. So there is some time correction ongoing. And I guess the time correction will stay till we achieve a PEG of closer to 1.6, 1.5. And hence, another year or two of no return from Nifty is something that is very, very possible in my view. Because that's how long it will take to basically achieve a PEG of 1.6, 1.5 times. 2 years it will take. And from there, maybe again, we'll see some money being made in passive funds and large cap products. In such times, in my view, what will work is a decent bottom-up approach. Remember, there are 5,500 listed companies in India, of which top 100 are large caps, next 150 are mid caps, and stock number 251 to 5,500 is small caps. So any statement which people make regarding small caps, I know there are some celebrity investors who come on TV or on various channels or on various communication channels, and they talk about small caps being overvalued. With all due respect to them, the fact is that small cap is a 5,250 stock bucket, and any one statement made for 5,250 stocks just cannot be true, simply because it's just such a wide variety of companies, wide variety of market cap. The largest small cap today in India, guys, is about 34,000 crores in market cap. That's a $4 billion market cap. And as per SEBI, that $4 billion market cap company is a small cap company. That's just how they've chosen to define it. I don't believe a $4 billion, $2 billion, $1 billion market cap company is a small company. It's definitely a very large company. Try creating a company on your own, which is worth $1 billion or more. You'd realize how difficult and how large a $1 billion organization is. So clearly, there is a lot of scope to make returns still in the market. If you're in the right pockets, in the right stocks at the right time, you can definitely make money. But if you're looking at a wide range spread 200 stock portfolio, there I think is going to be difficult to make returns for the next 1 or 2 years, simply because the broader market is overpriced and is looking at a lower earning growth than historical averages. So that's my 2 cents.
Perfect. So coming to Sajal sir, can we have a view basis your sectoral studies of different sectors, or maybe broadly how you saw the results of Q1 season so far, and what are your reasonable expectations for next 1-2 quarters to say?
The question was for Sajal bhai.
Yeah, sorry. So I was
Same
unmuted. No,
question to both of you. Anyone can
yeah,
start,
yeah.
sir.
No, I agree with Aditya's view that there are serious headwinds and we have seen some time correction already. We'll probably, it's a well-deserved further time correction. Because nothing can perform forever, and volatility is part and parcel of any long-term wealth creation. So we need both time and price correction at periodic intervals. Otherwise, it will become very easy to make money, and it never is easy. So in terms of my sector preferences, I mean, over the years that hasn't changed. Broadly speaking, it's science and technology within the pockets that I can understand and within the pockets where I can see the numbers matching the narrative. Because for me, narrative alone is never enough, and numbers alone are also never enough. So if you show me a great looking numbers in terms of ROCE, balance sheet, etc., but there is no narrative in the annual report or earnings transcript, I will not be interested. So I need to look at it from both ends. The narrative must match the number, and the number must match the narrative. And within science and technology, be it electronics manufacturing, be it defense, be it healthcare, these are the three, four pockets where I'm actively interested. And just to kind of hide my own ignorance, I do periodically look at other sectors where I believe that the sentiments have turned relatively pessimistic. And so it could be metals as an example, it could be some other sector. But majority of my allocation is always in science and technology that is backed by cash flows. Because that's very important criteria for me. So in that context, I think I'm still very much wedded to these two, three pockets. Defense is one area where I have not been very active because I never could make sense of the valuations in the context of the cash flows. Um, and I'm working on some of the ideas. I have a watch list, and I'm also preparing a detailed opinion, report, view, whatever you may call it, on the defense sector. But I think this is one area where Atmanirbharta from Indian perspective is very important. There are serious macro triggers for companies that are listed outside India, right? So Europe, as an example, they have got a lot of stake on the table. They got to invest disproportionately in the defense sector. They've been shying away from it, hiding behind the shield of US. Where that shield is dying. It's gone already. So I think defense manufacturing, defense innovation is a very large emerging area, and there are a lot of commonalities between the pharma CDMO and the defense quote unquote CDMO. That is kind of playing out perhaps in a very micro stealth mode in India. But I have very strong conviction that CDMO as a concept cannot be just restricted to chemicals, life sciences, pharmaceuticals. It has to grow and expand into any science and technology area. And I will use a comparison matrix, explaining why I say that CDMO is as relevant to defense as it is for life sciences, and when I published that report. But yeah, these are the three, four pockets that I like. Other than that, I mean, in terms of sectors, we see a lot of pain in IT space. I think that pain is justified. That pain will likely extend because the disruption that is being caused by AI. But I don't think AI is the only culprit. There are serious challenges related to growth globally, and IT is a non-discretionary. A large part of IT expenses that various sectors put into their budget on an annual basis is not mandatory. It's non-discretionary, It's not non-discretionary, it's kind of discretionary. So all that is um, under risk, and that's the reason the layoffs that these companies have announced. By the way, they are not openly announcing the actual number of layoffs that are happening, right? And all of them. So IT is one area where pessimism is there, but I don't think this is the right time to jump into most of these stocks. There will be exceptions even in IT, and some stocks will outperform, but that's one area where you got to watch for any sort of bottom formation. Other than that, I think auto components could be another example, because I think the supply chain move is here to stay, and whatever Trump is saying or the current administration is saying is just, the view of a contractor. And, none of these guys are the permanent members of White House, right? And so it's kind of a rental management. They have a expiry date, they have a sell-by date, and someone else will replace them eventually. But I think the supply chain rebalancing is a long-term phenomena, and that's not gonna go away. Aditya?
Yeah, hi. So, in my view, obviously, healthcare as a space, we still find value, more so in healthcare services, which includes contract research, contract manufacturing, even hospital diagnostics, branded generics. Very few companies have value now in branded generics because that's become more like a discovered story now. Outside healthcare, I would say one space which is looking very interesting to me over the next 3 to 5 year horizon is the NBFC MFI space. I think on the NBFC MFI space, things are bottoming out. Just to give you a sense, if you look at the 10-year history of the NBFC MFI space in India, the average ROE of the NBFC MFI bucket is around 14-15%. FY25 NBFC MFI bucket did an average ROE of -8%. That's -8. That is because they wrote off bad loans a lot last year, given the directives from RBI. Also, if you look at the average price to book of the space, it is between 2 to 3 times, depending. Some stocks have traded at 5-6 times, but some stocks generally trade between 1.5-2 times. So the average comes to around 3-time price to book. And currently that multiple has come very, very close to 1-time book. So what we are at Incred, what we are hoping for is that once the loan NIMs normalize and once the credit cost is also minimized. So last year credit cost was 10%. Average credit cost tends to be between 3 and 4% for the space. So once the credit cost sort of mean reverts to 3-4%, the ROEs will mean revert from -8 to maybe 12, 13, 15%. And the valuation multiples will revert from 1-time book to maybe 3-time book or 2.5-time book or 2-time book. So, you can potentially find multi-baggers now in the NBFC MFI space. If you have a 3 to 5 year horizon, that's a good space to invest in. There is a reason why the space exists, and the reason for its existence is that they lend to people the banks cannot reach, and financial inclusion is a part of the Indian government's agenda. It's a part of the current priority list of things that the Indian administration is working with. So clearly there can be a lot of value. So these companies will not die. Basically, the government will ensure, the RBI will ensure that these companies survive because they need them for the last mile connectivity to the consumers whom the large private banks or PSU banks cannot reach. And hence, there is a reason for their existence, and the reason is still very, very valid. So there's still a long way to go for India to become a financially inclusive country. So that's one space I think has become very, very interesting. Another space, along with the lines of what Sajal Bhai was saying, I think some IT companies I find interesting, but these are not IT services companies. These are IT product companies. Essentially, these are companies which are using the AI ML space to create product solutions for their customers. And, unlike IT services companies which are getting hurt by the AI disruption in the industry, these companies are using that AI disruption to create solutions for the customers and create sort of a subscription-based model with their consumer. And, extremely asset light, currently very hyped, and, very long runway for growth as AI evolves over the next decade. I'm sure some of these product companies will exceedingly do well. So one can potentially identify some stocks there which will do extremely high earning growth in the next few years. Another bucket where we find a lot of value today is consumption. So, consumption as a space post-COVID. So barring luxury consumption, post-COVID has done brilliantly well. But if you look at just, small ticket consumption or, middle to lower class consumption, that post-COVID just hasn't picked up. And I think with the 8th pay commission coming where, 13.5% year-over-year growth in salary is what the government employees will get, that would inject about 2.5, 3 lakh crores of liquidity in the market. And that liquidity will show up in consumption. It will show in two-wheelers, it will show in entry-level cars, it will show in affordable housing, it will show in wires and cables, cement, and so many other, maybe even consumer durables like coolers, fans, so on and so forth. So I think many of these sub-segments also have become very, very interesting, both from a earning bottoming out and a valuation sort of bottoming out perspective. And I generally, I as an investor, I look for such pockets. They become very interesting to me. Although the waiting period might be slightly higher, it may be 1 year, 2 year, maybe 6 months, I don't know. But even if the waiting period is there, once the earnings recover, as an investor, you make earning growth plus multiple re-rating. And that's basically the holy grail of investing for me. If I can identify pockets of stocks where, earning growth and multiple re-rating both is available to me at some point in time, I will definitely make significantly higher returns in the market. And that's how, I like this pocket as well. Last but not the least, I also like some PSU banks. The reason why I'm talking about PSU banks is because I think over the past 4-5 years, we have seen a significant improvement in operating metrics of PSU banks. Loan growth now is between 10 and 15%, which earlier used to be between 2 and 5%. Credit costs have come down. Credit costs earlier used to be 4-5% for the PSU banks. Now it's less than 1%. So FY25, all PSU banks put together at a credit cost of 0.6%. Just as a competitor, that number for HDFC Bank is 0.8, 0.9%. So, it is doing better. Those PSU banks as a bucket is doing better than large private banks, some of the gold standard large private banks. And that is where we believe, but the valuation multiples of PSU banks, although they have gone up compared to their own history, they are still significantly lower than private bank valuation multiples. And that is where I feel there is some narrowing of the gap warranted. So basically private banks won't become cheaper. It is the PSU banks that will become more expensive, from here. And that is where I think, again, you will make earning growth as well as significant multiple re-rating. And yeah, I mean, these are the pockets that look interesting to me, Prince.
Thanks, Aditya. So, Sajal sir, this question is for you. I mean, Aditya has highlighted the luxury consumption has been growing significantly, but the other part of the consumption are kind of facing headwinds or maybe have not picked up to that level. So, anything interesting or maybe any triggers you see, and if yes, then which pockets you believe can be something wherein we can look for opportunities. Sajal sir, Aditya bhai, was I audible or
Yeah, I can hear you. I was on mute, Prince. Sorry.
You are audible,
No,
Prince.
absolutely. So, when it comes to consumption, although the expectation was that the recent tax incentives and more money in the hands of individuals will likely spur consumption. I think it's early days, but we'd have to wait and watch because given this uncertainty, the trade tariff and the geopolitics, I mean, people may get into this mode of being overcautious and not spend all of that money or majority of that money. So the discretionary consumption, be it the QSRs or be it, the home improvement, because there are few pockets that have been struggling for very long. Um, right. QSR is one pocket that Aditya spoke about in one of the previous sessions. I think that is still is struggling, and so is building materials, although we have seen some recovery from the lows. But again, it's a question mark whether this recovery is sustainable or not. So that's one. The other aspect of consumption is the mandatory consumption, the kind of consumption that you cannot avoid. So healthcare as an example. And when it comes to healthcare, there's a wide pool. The entire value chain is made up of several different sectors, and the dynamics, the risk reward, and the model that you need to deploy to validate will be fundamentally different. So what works for hospital as a valuation criteria may not work for branded generics. So again, there are different sort of sectors within the wider universe of healthcare, but all of that is kind of mandatory consumption, and I think that consumption is here to stay. And our job as an analyst is to find out um, best possible management and the valuation combination, and then just ride out the story, ride out any interim volatility, and have a 3 to 5 year kind of a view. And over the cycle, I think the returns will be significantly better than the Nifty returns. But yeah, those are my views on the consumption. We can't paint all consumption with the same brush, but discretionary consumption is something that I would have to wait and watch, given the layoffs that are happening in the IT space, the geopolitics, the uncertainty, and it's almost impossible to predict what's going to happen tomorrow.
Right, sir. So coming to Aditya bhai, this trade tariff thing, I mean, primarily textile and the engineering space primarily looks like might be impacted more compared to other sector, but on the sentiment part, it is detrimental so far. So what is your reading when it can settle down, and if not, what can be the potential repercussions on other sectors? Basically, how you read all this trade tariff thing?
Yeah, that is one of the toughest questions to answer because you are asking me to second guess Donald Trump, right? So, I mean, I don't know if even if he knows what he's thinking, right? So, uh, look, the way I look at it, right? So we don't know what he will do tomorrow, right? So will this 50 go down to 10? Will it go up to 100? Will it stay at 75? I don't know, right? And I don't know what product, what services, if at all, will come under the ambit, right? But the way I look at it, so given this amount of information, what we have today, right? How do you analyze this? How do you use this to construct a portfolio, or how do you change your portfolio basis what information you already have without taking too much risk, right? So the way I look at it is any sector which is exporting anything to the US, right? Especially products, services are still relatively safer, but especially products, be it pharmaceuticals, textile, gems and jewelry, engineering, goods and services, so many other things, right, that we sell to the US. My view is that I'm going to stay away from those sectors unless those stocks tank 40-50%, hence giving me a margin of safety which can allow me to take the risk of buying those stocks and hoping nothing happens in US. You know what I mean? Because so for these pockets, the risk has gone up because Trump is doing what he's doing, and we don't know what the outcome will be and when it will be. But the stock prices haven't really corrected that much. Now, when the stock prices don't correct, but the events that are happening against the sector or against the company, as a fund manager, your risk has gone up and your reward has not. So that's actually a time to sell, or if you don't have it, it's a time to continue to avoid, right? So I had never held these companies. I've never held gems and jewelry, textile companies in my portfolios. I've never held engineering companies which sell to the US in my portfolio. So I'm sort of, blessed that way that I've never taken interest in these pockets, and these pockets are the ones today which are the most vulnerable. But now is not the time for me to start looking at it because for these companies, while the risks have gone up, the reward just hasn't, right? That's how I would use the piece of information that I have today.
All right. So, sir, you want to add to it?
And no, nothing to add. I think Aditya covered it.
And on the earning side, Sajal sir and Aditya bhai, I mean, any pockets wherein you are surprised or maybe the expectations were taken off on either side, be it on the positive or the negative?
I think it's individually. I mean, IT as a whole has been struggling. Again, there has been one or two companies that have positively surprised there. And again, same for CDMO and same for generics. I mean, many companies have disappointed on generics pharma side, and many have positively surprised on the CDMO side. I don't see a very clear trend a sectoral trend, where you can blindly bet on a sector and you will find 80-90% winners in that specific sector. I think it has to be stock specific. You have to go literally business by business. Chemicals as a space, I think, again, if you see, there have been uh, disappointments. Most of the companies have disappointed in chemicals space, but there have been some positive surprises. The agrochemicals as a pocket was expected to do well. I mean, if you look at Rallis has come out with a very strong number, but for every Rallis, there will be 4 or 5 companies that will be saying that, the agrochemicals is still struggling. There is pricing pressure, um, and the inventory and corrections are still going on. So, but as a universe, as a space, chemicals is looking very promising because as a proxy to consumption, if consumption has to do well, then the chemicals eventually have to do well. And this inventory correction cannot happen forever because otherwise, the everything cannot go to zero, right? So inventory correction is always on a base, and when you reach to a reasonable level on a product by product basis, and they will this correction will stop, the inventory and correction will stop, and what you would find is a normal kind of recovery in chemicals space. And for any reason, if they reverse the correction in the inventory and the customers start taking and the extra shipments, then it will only lead to further upside of randomness, right? So I think chemicals is one pocket that I would be very keenly watching out for. And the first sign of clear quarter across majority of the companies. So what I'm trying to say is 7 out of 10 companies will start delivering a positive quarter, and I think that would be an invitation, quote unquote, that would be an invitation, and that we must grab because I think once the recovery starts, it should sustain for a good 2 years.
Aditya bhai?
Sorry, Prince, could you repeat the question?
So basically, any surprises on the earnings on either side was primarily the question across sectors or maybe the companies or subsectors you are tracking.
So IT services clearly disappointed. I think most of the earnings in IT services were below expectations. Cement companies did well. Cement companies came in line or better than expectations because finally I think cement prices have started to moving up. Just to give you a sense, for the last 4 to 5 years, cement prices were more or less flat in the country. And I think that is where, a lot of disappointment was there. But I think now cement prices have started going up. So that's a good sign for most cement companies. And they did well. Other than that, within the healthcare space, generics disappointed. Revlimid is waning, and the new product launches are far away. What also disappointed was many API companies, I think, where they're affiliated to the generic ecosystem. So there also, I think the growth is wavering. What did better than expectation? Clearly, diagnostics hospitals did better. Branded generics were broadly in line. Amongst the other set of the universe, I would say autos were lower than expectations. Volume growth of 1% or so in the entire space is just not sort of lucrative enough for investors to look at it. Even I would say banking was broadly in line, with some banks reporting better than expected, but most of the banks were broadly in line numbers. I think finally macros are settling down on the banking side. So you would see some enthusiasm there eventually coming in from investors. I think that's it. I think the space which disappointed me the most was IT services and generics. The space which positively surprised me the most was cement and to an extent hospitals and diagnostics.
Thanks, Aditya bhai. So, Sajal sir, apart from the smart SIP, is there any other natural hedge in such market conditions wherein, I mean, the direction or to say there is no clarity or maybe a confusing market to say for majority of the participants?
No, so there are two ways. I mean, you could play tactically, you could play a cyclical, where you know that the recovery is short-lived or will be short-lived, and you can play for 2 3 quarters. And again, for those, you have to wait for clear signs of recovery, and you don't have to take a sectoral call for that. There will always be companies across sectors. So any sector you would find a company where you can understand. See, you need to first understand the sector to be able to validate the management and make sure that you have at least few good quarters coming up next, and the asking valuation or the run rate of valuation, be it EV, EBITDA, or any metric that you use, is not is below the long term average. And on that base, if you are fairly certain that the next 2-3 quarters will be promising positive, then I think your downside risk is pretty much taken care of. So that's one. And SIP again is a very abused thing. I mean, you cannot blindly buy on a monthly basis, regardless of the valuation. So, for example, if the stock is 20 times price to sales, you cannot go full throttle on SIP on that specific stock. But at the same time, just to maintain the discipline, you cannot stop the SIP also. So there is always that throttle or the lever that you need to control depending upon, how the market is placed, how the sector is placed, how the business cycle of the stock is placed, where the sentiments are, and then you either go 100% on that specific stock or you go 5%. And that's the sort of range. If the market is bullish and sector is bullish, so let's take an example of CDMO. The CDMO sector is hot today. Within that sector, if you find a stock which is trading at 20 times price to sales, you cannot go 100% monthly SIP on that stock. What you should be doing, or what I would do in such a scenario, I'll have a checklist, and the checklist is very simple. How is the market doing? So market is reasonably positive. How is the sector doing? Sector is really hot. And so I'm talking about CDMO here, obviously. And is the stock down today? The answer is no, because the stock is already 20 times price to sales. There is a fair bit of optimism around the stock. The sentiments are not down. So all things said and done, I would just, normally I would invest $100 in that specific stock. Today I would only invest $5, but I will not stop the SIP for the simple reason that I want to maintain the discipline of committing incremental capital on a periodic basis. But again, if that stock crashes tomorrow and the valuations are much more reasonable, let's say 5 times price to sales, crashing all the way from 20 times price to sales, will I continue with that 5 rupee or 5 units of SIP? The answer is no. I'll probably try and do more than 100% if my financial resources permit. So this is the very simple template that I use personally, and I would recommend, and that you need to control the throttle. And you have to be super bullish on your SIP allocation, or you can be super bearish on your SIP allocation, but try not to stop the SIP, because once you get into this habit of stop start, there is a possibility that the expensive stock may become even more expensive, and then you lose out. So stay in the game. Be prepared to ride out the volatility by simply flexing your monthly SIP allocation, and make it flexible between 5% of what you would allocate in normal scenario, all the way to 100% or even slightly more. So 120% if it's extremely bearish. So for example, if Nifty starts crashing tomorrow and the CDMO sector loses, it goes out of favor, and it happens periodically. Every few years, you will find that any hot sector will lose the favor. And there will be several stocks that have performed reasonably well in the previous cycle. They will correct 60-70%, as long as the terminal value is not being compromised, and that's your judgment. You need to have a fairly good understanding of the sector and the business. As long as the terminal value is intact, it's only the stock that has corrected and the valuations have become reasonable. I think that's an invitation for you to increase allocation in form of monthly or quarterly SIP. What That's how I would tend to do, and that's exactly what I do.
Right. So Aditya, you want to add anything to it?
Yeah, I think that's a fair point made by Sajal. Nothing to add.
Right. So, Aditya, for some quarters, we have been discussing about the private capex has not taken off, which has been, anticipated or expected since long time. So, do you think there are anything, which we are not able to see, or maybe you are reading basis which and this private capex is not picking up?
No, so look, private capex is driven by consumption here. Private companies do capex when they need more capacity. They will need more capacity when there is volume growth in the industry, right? And volume growth in the industry comes from consumption. So simple and clear, private capex picks up when consumption picks up. Otherwise, private capex just completely shuts off. In fact, I don't know if you guys are glued on to the news right now. There is just at this point there is a news that the government has put out a release where they are suggesting GST on essential items like food, medicine, education to come down from 5% to 0%. GST on insurance to be slashed from 18% to either 0 or to 5%. And also AC, TV, refrigerator, washing machine GST to see a drop from 28% to 18%. So this is, I think, government's proposal. I don't think this is approved yet, but government is proposing GST cuts across consumption categories like food, medicine, consumer durables, insurance. So why are they doing this at this point, right? This news just came out like 30 seconds ago. So why are they doing this? Because they're seeing no volume growth in the industry, and the government also wants to push for volume growth. So they're cutting GST so that it becomes more affordable and then people consume more. So once people start consuming more, Prince, that is exactly the point where a private capital or a private entrepreneur says that now I need more capacity because I can see myself selling more units than I was selling last year or this year. So that's how, private capex picks up. So it will always lag consumption growth. So, first will come consumption, then private capex. Public capex is something which is just parallel to it. Government can choose to spend whether there's volume growth or not, because government spends on infrastructure, roads, so on and so forth, which is, not something linked to consumption.
Right. So, Sajal sir, like last time we were speaking about the ancillary space, although you touched upon that. So this layoffs which are happening maybe majorly in the IT sector, is it one of the reasons, or that quantum of, I mean, we can say is causing real estate pain, or you read it differently?
So again, we need to see the data. IT is not pan-India, right? So IT is predominantly in certain pockets. So Chennai, Bangalore, and Hyderabad, and those are the real estate markets that have always been fueled by IT. But IT job losses, there are also few job creations happening in GCCs. But I doubt if the volume of intake from GCC will be able to match the offloading from the IT sector. So net, I'm a bit skeptical about the sustainability of the consumption. Again, it's a dynamic situation. Things are changing almost on a daily basis, and that's the fun part of investing, right? What I say today or do today will probably look like an idiot tomorrow itself. Such as the degree of randomness in the system currently, but it's something to be mindful of. And it's not just AI. I repeat, it's a combination of global slowdown, an IT service is a service getting extended to various industries. So that's, I think, probably one of the major factors, not just AI. AI probably is playing its part, but AI is not the dominant factor today. AI possibly may become very dominant over the next 2, 3 years. But at the moment, I think it's the global slowdown and the budget cuts across industries that is forcing these service providers to go for retrenchment.
Right. And Aditya, when it comes to China, it's majorly majority of the things not clear. I mean, with the ongoing things happening with the US and slight news of China opening up to India, is it too early to assume something positive on that side? And I mean, how you read this equation wherein the Russia, China, and India coming together, or it's more of a news rather than anything happening on ground?
No, I think things are happening on the ground. I don't know if you read about that Naira Energy cargo ship that was headed towards Europe, and the moment Europe banned processed Russian oil from India, that Naira Energy ship, which was carrying Russian refined oil, uh, sort of changed course and went to China, and China bought the entire container of the ship from India. Um, Look, I think geopolitics is not about alliances. It is about being opportunistic at the right time. And I think that is what India and China are being today. make no mistake, there is no love lost between India and China. We have our border disputes. We have several issues and tensions with China, and several reasons for why we are in each other's crosshairs. Uh, but that doesn't mean that if we are both being bullied by some other guy, then we won't sort of come together to send a signal or a response to the bully. And I think that is where today India, China are working together. But let's say if tomorrow China ends up with a tariff of only 10%, while India has a tariff of, let's say, 40 or 50%, I can guarantee you that China will become better friends with the United States and will not even think about India, because that's just how geopolitics is. Everybody looks for their own interests. Uh, so at this point in time, the India-China partnership looks to be going in the right direction. There is the truth, and there is an element of reality in that narrative that is visible in data, that is visible in corporates when you speak to them about how frequently people are now talking to their Chinese counterparts and transactions are happening. Um, and I think there was some flight visa issue also between India and China, which has also gotten resolved now. So all these things are indicating that yes, these three people, India, China, Russia, are kind of uniting to sort of present a strong front against the United States. But having said that, end of the day, they are all uh, countries which, in the game of geopolitics, will look after their own interests. So if tomorrow things change, these partnerships can change. So there is nothing cast in stone. Um, but it's a good move, given that US was trying to bully the entire region. These three strong parties coming together obviously creates a very formidable opposition to the United States administration. I think that was required. And I hope that this will help each of these guys bargain better with the United States. Today, President Trump is meeting President Putin in Alaska. So I think let's wait till tomorrow while we get the news of what the summary of that meeting was, or what the outcome of that meeting was.
Right. Sajal sir, one question is around that ethanol thing which is happening. I mean, there are several complaints coming, and one insurance claim which was rejected basis using E20 was, doing rounds on social media. However, Gadkari ji denied, and his focus on E20, adding ethanol 20 has been firm. So is there anything to read? Is it so as to push EV, or if you have any thoughts around this thing?
Well, I'm not sure about the conspiracy theory or the sinister angle behind it, but this ethanol blending risk and engines incompatibility risk was clearly highlighted way back in 2022 on this podcast series that we have been conducting. Right, and I clearly called out that no company can build future basis just one source of cash flow, because that doesn't give the optionality, the desired optionality, right? And if your source of cash flow is highly fragile, it could be because of one product, it could be because of one customer. And again, when it comes to defense, that's a source of clear fragility, that your buyer is a single party, it's a single customer buyer market, right? In defense. So we have discussed these kind of attributes that add to the complexity. But I I've got no doubt that there are certain automakers, if not all, will definitely fail to comply with the E20 rule, and especially with the vehicles that are probably 6 or 7 years old. Because I mean, imagine when that kind of a vehicle would have been produced in the factory, right? So if you bought a vehicle which is 7 year old, that may have been lying in the dealer for about a year, that may have been manufactured a year earlier. So it's about 9, 10 years of technology gap. And if you're using the E20 just because it's permitted and you can buy it, doesn't mean your engine will start loving it. So those kind of issues, I think they were expected. And you need a proper ethanol friendly engine, the likes of we find in Brazil as an example, and only then the blending can go up. Unilaterally changing the blending from 5% to 10%. I mean, here in the UK we get 10% blending and we also get 5% blending. I know my engine can easily take 10% blending, but I only go for 5%. because I want to be having some margin of safety, right? It's common sense.
Right, sir. So Aditya bhai, couple of questions on the hospital. So let me read out. One is a broad view on the valuations in the hospital sector, barring special situation. One name. And second, he's saying, Sid, yeah, wanted to understand the huge gap between valuation per bed of certain hospital chains. Some of the starting valuations have gone up to 60 times EV/EBITDA. I wonder the framework for this justification or entry valuations. Any perspective will be helpful.
Sure. So at a very broad level, right? At a very broad sectoral level, I think hospitals have become overpriced. So we have to sort of be selective now when you buy hospital stocks. So 3 years back, no matter which hospital stock you bought, today would be sitting at significant gains, right? Because the entire space was undervalued. Now clearly the space has come in limelight. People are talking about it. People want to learn about it. So clearly the valuations are trending on the higher side. Having said that, are there still opportunities within the hospital space to buy stocks which are reasonably priced and earning growth trajectory looks good? The answer is yes. And what is the right metric to look at? So we have historically talked about EV/EBITDA, although now remember EBITDA does not include rent, so may not be the right metric to look at hospitals anymore. I think the right metric to look at hospitals, in my view at least, is EV to operating cash flow minus the rent component which appears in financing cash flow. So you kind of can do your own calculation there. And EV per bed, I don't think is the right metric, simply because let's take example of a Max Healthcare, who, no matter how many beds they have, all the beds are in urban India. They're in like prime locations within the metropolitan cities of India. They will definitely get more EV per bed because the replacement cost per bed is very high compared to that of, let's say, an Astor DM, which has multiple beds in tier 2, tier 3 towns, and his EV to per bed will definitely be lower because his replacement cost per bed is significantly lower. And hence that results in lower ARPOBs for an Astor and higher ARPOB for a Max, and which results in higher margins for Max and lower margins for Astor when compared to Max. So I don't think EV per bed can be blindly compared across hospital chains. I think the most comparable metric is EV/EBITDA or EV to OCF, where you deduct the rent component from the OCF. So you have EV to OCF minus rent. I think these are the two metrics which I would encourage people to look at. And yes, the answer is yes, there are opportunities still in the hospital space, but many hospital stocks have become insanely, crazily valued. So you are better off sort of avoiding the crazily valued names as well.
Right. So another question is on a stock. We can surely give it a pass if not, but the person is asking your views on Heikel regarding OAI issue from US FDA.
So in Heikel, my view is that if they have an OAI, they will not be able to get fresh approvals, which implies growth will be an issue. I am also disappointed in Heikel in the way they have run their pesticide business, so the crop protection business, where essentially, while we have seen recovery in many other names in the crop protection side, Heikel numbers are still not sort of reflected that recovery, and the management isn't even very confident of that recovery in the next coming 2 or 4 quarters. So for me, even though I used to hold Heikel for a very long time, currently the prospects don't look very good from a earnings growth standpoint. I'm not talking about the stock here, I'm talking about earnings growth. So I don't see the company reporting very high earning growth numbers in the coming 4 quarters at least.
Right. Sajal sir, you want to add anything or shall we move on to next question?
No, absolutely nothing to add. I mean, we have to wait and watch the outcome of OAI. I mean, I expect a warning letter and not the import alert, because you need to go one way or the other, and FDA will take its own time. And I also joined the earnings call, and the second half of the earnings call was much more interesting, if I'm completely honest. And the guy who was ahead of myself in the queue raised a very challenging observation, saying that long term should not be only about grandchildren. And he's right in the sense that if you look at the Heikel's P&L, right, and their trailing 12 months PAT. net profit is same as 2007 or 2014 PAT. So for 10 years, the PAT hasn't grown. And that's a serious underperformance. I mean, you can create a CDMO business from scratch in 10 years. So that is where the question mark is from most of the investors. And I think rather than guessing and speculating that because the stock is corrected and the valuations are reasonable, the valuations are reasonable for a reason that the last 10 years net profit hasn't grown. So wait for the net profit recovery, wait for the margin recovery, and wait for the outcome of the US FDA OAI, and then see, it may be much safer to buy this stock above 300 if all things are resolved and the margins are 20% and everything is looking back on track, rather than bottom fishing and buying the stock at 200 and then finding it lying in this range of 200, 250 for another 2 years. Who knows?
All right. So Sajal sir, one question is on the metals. The person is asking, since May metals have seen good inflow but haven't performed in tandem. So any thoughts on the metals as a sector?
No, so we covered one metal stock on the Substack. Let's not name it because the stock has appreciated since then. The only reason that metal stock was picked ahead of others was there was a science and technology company hiding behind this metals as a sector. And this company has got scientists working on the next set of rare earth metals, which I think is a very hot topic. And and I read widely. I read the annual reports, and I just screen for those kind of spots where the market is ignoring one or two factors. And this metal company caught my attention from a science and technology perspective, the R&D perspective, and that's why I shared my thesis on this one on Substack a couple of months back. And I think, luckily, fortunately enough, despite the global headwinds and uncertainty, the stock has done reasonably well. And anyone who bought that stock around that time is sitting on decent profits today. But other than that, it's difficult. I think I've shared 2, 3 names already. And I mean, let's try and refrain from taking stock names, but I'm reasonably positive on metals as a space because when, this, you cannot keep on fighting forever. Otherwise, it's a holocaust, right? And we all, it's a gloom and doom. We all will die anyway. But assuming that better sense will prevail and reconstruction activity and economic growth will return, then I think metals will be a sure winner.
So Aditya, same question. Anything fitting in your framework from this metal space? Even we spoke about it last time also.
Yeah. So I don't track the space very closely, but there were some issues with some supply of some metal alloys from Australia because one of the largest mines of those alloys had been shut because of flooding. And now, in the meanwhile, the prices of those alloys went up, and now the prices of those alloys are falling. So if you can find ferrous alloys, basically, so if you can find companies that benefit from declining ferrous alloy prices, I think that's where in metals, currently you have some opportunity. But that's about all I know in metals.
All right. So Aditya, last time or maybe last to last time, we also spoke about the telecom opportunities. So any change of view on the sector level, or I mean, that's more or less.
No, I think that view stays. Yeah, I think ARPUs have definitely bottomed out. We have already seen significant increase in ARPUs over the last 18 months now. And I think that trend is here to stay. You will continue to see some increase in ARPUs across telecom companies. And I think, last time, if you remember when we spoke, there were a lot of questions on how Starlink can come in and disrupt telecommunication companies. And I had said that, look, that's a pipe dream, and I would be really surprised if it materializes anytime in the future. So that still remains my stance. I think stuff like Starlink is not going to be a mass product. And it's not gonna replace telecom companies, at least in the next decade or so, I hope. Although you can never say never, but I think telecom companies will continue to increase ARPU, subscriber addition will continue, and these companies will continue to report very good numbers.
Right. So, Sajal sir, one question is again on a company. You can surely give it a pass if we don't want to discuss. So, is asking about, although we have shared the views in the past on PI industries, is asking view on pharma business and agri business as they are guiding for strong growth for the biologics.
I'm not too sure about the biologics capability, but one thing that has disappointed me when it comes to the pharma capabilities, I mean, PI as a group has been working on pharma for almost 15 years now, if you track the older annual reports. And it's only now that, and now as in the last quarter, they've shown some improvement in the pharma. Again, it's a zero base after 14, 15 years. So on that base, you are bound to surprise on the upside. But the question mark remains that, how sustainable this growth will be, and can you create 1,000 crore pure innovator on patent CDMO, and how fast can you create get to 1,000 crore on patent CDMO? No, not just talking about generic CDMO, because a lot of these companies also do generic CDMO, um, right? And so even Tube Investment as an example, they're talking about CDMO for a while now, but they're also doing generic CDMO. So you got to be very careful, not just take it on the face value, but I would like to see, how fast PI industry can create 1,000 crore. Because my conviction is very clear. India will have very few um, on-patent CDMO manufacturers 5 years out that will have turnover coming purely from the CDMO sector in excess of 3,000 crore. And a handful of companies will report 5,000 and 10,000 crores purely coming from on-patent CDMO, not generic CDMO. So even TVs has got a mix of both on-patent and off-patent. So very few companies will have the DNA to scale it. And there's a reason why India hasn't got a Wuxi. There is a reason, but I expect one or two Wuxis hopefully will emerge out of India. They may not become as big as Wuxi in as short a period of time as Wuxi has been, but nevertheless, given the current base and the imminent structural change in the supply chain that is happening, and there will be, two or three very dominant gorilla-sized companies in the CDMO space, and I believe PI Industries will not be part of that elite four.
Right, sir. Sir, one question is on the book, page number 109, and is asking about throw some light on the situation explained R&D flow, reduced funding of large biopharmas, etc.
Yeah, I think that's an outcome of the headwind because money is in short supply, and when money is in short supply, the VC money in particular, they will do all sorts of due diligence and they will ask these small biotechs to purge some of their early stage pipelines. So molecules in phase one and preclinical, they are the first to be shot down because you don't want to take chances where the probability of a successful outcome is too low. The probability of successful outcome is ridiculous in phase two. So only 25-30% success rate happens from a phase two to commercial. 70% or more will be dropping out from phase two. It's only from late phase three that the probability of success improves to something as high as 60%. And those are the assets that the small biotech and the VCs will be much more willing to bet because they are nearer to the D-Day, right? And so when your pipeline is fully pregnant, your 8th month pregnancy, so to speak, when you are in late phase three, you would rather bet on that instead of an initial pregnancy because the miscarriage risk is very high. That's the sort of analogy I would like to put.
Right, sir. So next question is for Aditya Bhai. Martin is asking, would like to know Aditya ji's view on the CRO space considering how AI is helping research outsourcing. Can this segment be disrupted would like to know this in context of Syngene, if we can add.
Yeah, so look, I think the CRO space will use AI rather than get substituted by AI. It will help CRO organizations probably become more efficient. It will help them fail early. So I think Sajal Bhai has earlier spoken about it, that when you have like 100 candidates in pipeline and you want to focus on the 10 most likely winners, failing early is important. And I think that's where the AI piece is helping at this point in time. I don't know to what extent AI will go in future, but for now, most CRO companies seem to be using AI to become more efficient organizations, and that is sort of helping the CRO ecosystem rather than harming it. Specific to Syngene has very different challenges. I don't think AI has much to do with that. I think Syngene has some execution challenges at a standpoint and at a customer management standpoint, and I think those challenges over time will get resolved. It's a matter of time before Syngene becomes stronger as an organization. That's my view. Sajal bhai, let me know if you differ in any perspective here.
Yeah, a slight difference again because of the way I like to practice rethinking and reframing, and I've been a big bull on CRO myself, but the latest set of evidence and my industry interactions, which happen frequently, are suggesting something very interesting here, where CRO as a outsourcing space, I think is already facing the headwinds. It's more pronounced in some companies that are heavily reliant on CROs. Syngene is one of them in India. The other CRDMO, something like a SciLife or a Anthem Bio, it's less visible because their base is smaller and they are relying more on the manufacturing. But I'll give you a very common sense kind of uh, an opinion more than anything. How many CROs have you seen craving for forward integration into CDMO? Almost every. Almost every CRO has or in the process of trying to become a CDMO, manufacturing. So that's forward integrating from CRO to CDMO, right? Even Jubilant Pharmova is aiming to do that. Currently, they are also predominantly a CRO. How many, when you flip it around, how many CDMOs have you found backward integrating into CRO? Almost none. Why is that? CDMOs are in no mood to quote unquote misallocate capital and go into CROs because again CRO today is a kind of a modern day textile garments kind of a business thanks to AI and the rapid pace or velocity shown by these LLMs, the language models, right? The AI language models, the rapid strides that this technology is making, and even companies such as Google or DeepMind is looking for manufacturing partners in India, believe it or not. So, manufacturing, I think, or the CDMO, and I've said this many times, especially on the small molecule side, that is here to stay, that will only grow. But CRO as a space, I would be very cautious about, and Syngene is a prime candidate for disruption here. I mean, look, when Syngene's IPO came, the management, the gap between Wuxi and Syngene was about 3 years when Syngene's IPO came. And I remember Kiran Shaw's ET Now interview where she said, we will be the Wuxi coming out of India because the only difference between a Wuxi and Syngene is the manufacturing and we'll pick up manufacturing. I mean, 10 years on, I have not seen manufacturing small molecules coming out of Syngene, and the gap that was 3 years between Wuxi and Syngene today is more than double. So Wuxi is a lot larger today than it was relative to Syngene when Syngene's IPO came in 2015. So the gap has only increased, right? So that's clear underperformance or
But Sajal
non-performance rather.
bhai,
Huh?
sorry. Sajal bhai, that is where my doubt is here. So I was also doing some work on this AI disruption of the CRO space, and then I looked at Wushi's numbers. Wushi में तो कोई AI led driven disruption दिख नहीं रहा है. So from I mean, I understand that Syngene might have execution challenges. वो तो मेरे को भी clear है की challenges है उधर. But is the technology itself disrupting Syngene, or Syngene is not being able to deal with it because Wuxi तो grow कर रहा है.
Huh, but if you look at the growth of Wuxi that is coming from CRO vis-a-vis the growth coming from the CDMO or the manufacturing, that is where
Hmm.
the difference is. I mean, CRO तो साई का भी grow कर रहा है, Anthem का भी grow कर रहा है relative to even Syngene. So
Correct.
problem is not just limited to CRO, but I think there are early indications that technology. I mean, imagine a scenario where LLMs are so advanced 2 years out that these big pharma they decide to bite the bullet and they say, let's do a one-time capex and bring all that outsourcing and IP risk in-house rather than
Hmm.
outsourcing our IP. Will they not do that? I mean, if I'm in the board, I will definitely go for that if I've got high confidence in the LLMs. And this technology is only going to improve.
That is true.
So
That is
that is where my challenge lies with. And again, Sinji, look at Anthem Bio. It's kind of a quote unquote spin out of Biocon Group.
true.
Ajay Bharadwaj started Anthem Bio coming out of Biocon in 2006 or thereabout, and look the market cap of Anthem Bio today versus Syngene. It's almost
Hmm.
2x.
Hmm.
The serious problems with Syngene. Again, that is what happens when you go with quote unquote a rental or a contract management. See, my firm belief is that a high quality CDMO must be owner led. And there is enough evidence of that if you look at the listed space. All the companies that are giving exceptional or that have given exceptional performance in recent quarters are all owner-led. None of them of any scale is led by a rental management or a ESOP incentivized management. You have to take bold calls, and you need serious skin in the game to be able to take those bold calls.
Very, very fair point, Sajal bhai. Thank you.
Thank you.
Thank you. So next question is on Entero Healthcare. He's asking company growing at 30% and profits are growing at 50%. Globally, the pharma distribution is concentrated. So is it fair to assume that the company has capability of achieving 10% market shares in 10 years in the domestic pharma?
uh, Two things. So when you say globally, or when the person who's asking the question is saying globally, he's looking at United States. In United States, pharma distributors and retailers make money because generics are not branded. So it's a push business rather than a pull business, and hence distributors and chemists decide which SKU sells, and they take their cut for selling that particular SKU. In the India business, there is a difference that we are branded generics, so there is a pull-based business rather than a push-based business. Case in point in Entero, I don't know the person who's asking the question if he has position in the stock or not, but if you just study the cash flow statement of Entero, in their history, they have not made positive operating cash flow. They burn cash every year, every year. Their working capital is far higher than their EBITDA margin. So when I say that, what do I mean? I mean that if their working capital is, let's say, 10% of sales, their EBITDA margin is 5% of sales. So every time their sales grows, they actually burn cash. So the long and short of it, can they become 10% market share? Probably yes, because they have grown inorganically. They can continue to borrow capital or continue to dilute equity and continue to acquire all they want. But unless they can fine tune their business model to when they can start generating cash flow, I will not be a buyer in their stock, because I don't buy businesses who burn capital, and that too on a sustainable basis.
Right. So, Sajal sir, next question is on molecular diagnostic. The person is asking about 3B Black Bio recent acquisition of Cortis Holding.
Look, I haven't researched this transaction in any sort of materiality to be able to, give my 2 cents. So I'll give it a pass.
Right. So Aditya, next question is on the MFI space. He's asking what are the matrices to track to understand the cyclical uptake, collection efficiency or PAR 31 to 90, GNA, NPA. And second part of the question is what are your views on gold financer at this point, given that they had a great business traction in the recent times? Aditya?
Sorry यार मैं म्यूट पे था मैं बोलने लग गया sorry. I'll start again. So basically I will take the gold question first. So I think gold financiers will continue to have a good time ahead as well. Why? Because I am basically a bull on gold even at these levels. Why am I a bull on gold? Because dollar has lost the global trust of central banks. And now, whatever incremental capital that central banks have and they need to park, I don't see them parking in US bonds or US treasuries because US can decide to freeze those assets whenever they want. And no country would want to take that risk on their reserves, right? So I see incrementally central banks buying more gold, which will create a lot of gold demand, which will basically create spikes in gold prices periodically, if not consistently. And I see gold financiers using higher gold prices to lend more capital safely, and people also borrowing more against gold because the same amount of gold will become more valuable than it was earlier, and hence they will be taking higher amount of loans against those gold rather than what they are taking out today. So gold finances are continue to be bullish. Obviously, valuations for each stock, one has to do their work and realize which stock they want to play within that space. There are multiple ways to play the gold financing space. The first question was on collection efficiency of which pocket, Prince?
So basically, he was asking about the matrices to track in MFI
Yeah,
space.
yeah,
Collection efficiency was one, gross
yeah.
GNA and NPA, and one was PAR 31 to 90,
Yes,
maybe the
yes.
period.
PAR 0 to 180, 31 to 90. All of these are relevant metrics. GNPA, NNPA, NIMS, even credit cost, and also ultimately the resultant ROEs. I think these are the important metrics to track.
Right. So next question is common for Sajal sir and Aditya bhai. So question is on healthcare enablement. He's asking mainly for US like IKS, Indigene, Sagility. Are these where IT services was 20 years back?
So look, I have done some work on a couple of these. I don't feel that confident. IKS Sagility might be slightly different businesses compared to, let's say, one other company I researched, I forget the name. But that company is like a IT services company which is specializing only in the healthcare vertical. Um, and I don't see them doing great in the future as well. I feel top line growth will be in single digit only. Sagility IKS have some more niches that they are operating in, and there might be some steam there. But again, one has to be cognizant of what valuations you are comfortable buying these companies. Are they where IT services were 20 years back? I wouldn't say that is the case. I don't see that much of a growth potential, but I do see some growth potential.
Sajal sir?
No, yeah, not my cup of tea, so it's a pass for me. Sorry.
So next question is again, Aditya bhai, in April 24, we remember some good opportunities we discussed as paid to wait. So anything, I mean, obviously names are not important, but pockets as such, maybe both from both of you.
I think PSU banks paid to wait. I get dividends, low valuations, decent growth in earnings, and margin of safety. So one pocket where clearly I see today I'm being paid to wait is PSU banks. Another pocket, selectively there are companies in logistics where there are some challenges because of which the stocks haven't uh, really moved much. Valuations have become very reasonable, dividend yields are fairly high, and I do not see any terminal value risk to those businesses whatsoever. So some logistic businesses, some PSU banks, and very, very selectively a couple of NBFCs is where I see the paid to wait opportunity playing out.
Sajal sir, you want to
Uh,
take
so
that?
for me, paid to wait, again, there may be one or two CDMO companies. I think they have not yet shown their true colors, so it makes enough sense to wait another couple of years in those and just see, the kind of earnings that will probably surprise most of us. And the other example that I would say, because of the limited downside risk, is chemicals, as I said, and there is enough to be made if you can wait. If you have got a 3-year horizon, most of the chemical companies that have performed in the previous cycle will likely do much better than the Nifty itself, and some of them will be a multi-bagger in a 3-year kind of a time frame. So those are the two pockets where I think paid to wait will work. Hospitals will probably test. I mean, again, one SCG being an outlier from 550 to 650 in a jiffy. But by and large, if you track the hospital space, they have been undergoing a time correction. And they truly deserve the time correction because the stocks have been 6x, 7x in last 3-4 years kind of a time frame. And the space is still structurally very positive, but you have to now be patient enough for the valuations to catch up and mellow down, and then the next wave of recovery can happen. And same for branded generics as an example, be it RPG Life, be it JB Pharma. We have spoken about these names before. There is a limit to which the trees grow, and you have to be cognizant of the fact that you can't wait forever. Once you get paid, you have to exit also, right? So there has to be a certain predefined. You can't make that call thinking on your feet, right? You have to have a documented framework that how much greed is enough for me and what will be my exit criteria ex ante, not ex post. So you got to be very clear upfront. Don't fool yourself. Jot it down in your logbook, and you make sure that you stick to what you set out as your goal. And if you're buying something at one time price to sales, and you say to yourself that the moment it reaches 4 times price to sales, come what may, regardless of how bullish or positive this story may sound at that point in time, I will reduce 80% if not exit. You got to then execute it. The problem happens when people start assuming that a cyclical at the top of the cycle is the next Abbott or the next Nestle. That's where the challenges emerge, and then you end up waiting for the next cycle of exit, which may be 5 or 7 years away.
Yeah, that is true. I think that happened with chemical companies during COVID. I think many investors thought that those margins that chemical stocks were reporting, a chemical company on an average doing 15-18% EBITDA margin historically started reporting 25-30% EBITDA, and people extrapolated that to eternity. And I think that is where, a lot of people lost money, and if not lost money, lost time, a lot of time value of money. So yeah, one has to be cognizant what industry, which stock, which company is structural, or the improvement in their financials is structural, and what is cyclical. And if you are at a cyclical high, you need to avoid. If you are at a structural high, likely to remain there, then you can definitely evaluate basis valuation, whether you want to get into it or not.
Right. So next question, Aditya, is on the affordable housing finance. The question says now everyone is interested in doing affordable housing finance. Will the competition put pressure on NIMs or the market opportunities are really huge?
I think the latter. I think market is big enough to accommodate many suppliers in the housing finance space. And एक second, hold on. Sorry. So basically, yeah, so there is enough space for multiple players, I think, in the affordable housing space. Look, India is a massive geography. It is a small economy relatively compared to the size of the people we have, because per capita income is low. But anything which is affordable will have a lot of takers. And given the pyramid income pyramid of our country, and hence the opportunity in affordable housing is pretty large. So I think competition will not be an issue. Competition will not impact NIMs. The key performance indicator in the affordable housing financing space will be your underwriting skills. How far and how deep do you go to control your credit cost? I think that is going to be the key differentiator.
Right. So, Sajal sir, do these companies find space in your framework, or maybe sometimes some cyclical plays to
No, I
say?
think the cycle is set to play out. I agree with Aditya's view, and housing finance is relatively a safer because it's secured lending, right? Common sense. Unsecured lending will always be higher risk, and secure lending, housing finance companies, if you track their performance, both large and mid caps, haven't really performed over the last several years. But perhaps now is the time the cycle is turning because housing is a serious challenge, and no government will try to sabotage this space. This cycle is ripe for an upward correction, but one needs to be careful that at the peak of the cycle, and these cycles keep repeating, the story will look dramatically positive. Like the chemicals story was looking so very positive in 2021, but that was the time you should have exited. Exactly what happened with the diagnostic companies in 2021. I mean, there were um, companies like Metropolis and whatnot that were trading at 15 times, 16 times price to sales. I mean, there is only one way the traffic could flow from those levels. It's just a matter of time usually. A 15x price to sales stock may become 20x price to sales stock, but the probability of that happening versus the probability of a serious correction is much higher, the probability of serious correction, right? So from that perspective, you got to be mentally prepared to ride out the recovery. But once the recovery is all fully blown and media, Twitter will tell you when to exit. That is the only reason one has to be on Twitter. Never use Twitter to decide what to buy. Use Twitter to decide what to sell.
Guys,
Perfect. Sir,
basically
one,
on this, yeah,
yeah,
one more thing here, Prince. Investing is not very complicated here. People make it complicated. It is simple. You buy low, you sell high, right? Now, when I say buy low, sell high, I do not mean absolute stock price. I mean valuation parameters, right? Buy lower valuation companies. If the story is good, if market is just not appreciating the quality of the management or the business model or the moat or the um, whatever it is, right? And cash flows, and then you sell when it becomes too much of a hype, right? It's just very simple. People overcomplicate things in their own minds. They listen to 10, 20, 50 experts, everyone with his own style, his view, his own interest areas, and his own baggage from his own experience, including me and Sajal Bhai. We have our own biases, our own baggages, our own frameworks, uh, which is why these discussions are so interesting with him, because his framework is different than mine, his experience is different than mine, his views are different than mine. And that is how each of us are. So people confuse a lot of things into investing. It's very simple. You do not buy over expensive stocks unless you have very, very high degree of confidence that these stocks will continue to do well, because the business will continue to grow at like 20-30% top line, right? And you do not leave out cheap stocks if you feel confident that these stocks can even do moderate growth in line with the GDP of India. If they can do that, then stocks which are very, very cheap will give you very, very good returns.
Yeah, absolutely. And just to add, see, there are only three variables. I mean, Aditya said investing is very simple. Absolutely. There are only three variables. There is greed, there is fear, and there is discipline. I mean, fear will make you sell low, greed will make you buy high, but ultimately it's the discipline that creates the wealth. And the biggest risk in any investing is if you stand in front of the mirror and the person is staring at you is the biggest risk. That is yourself. And it's always the case. There is never any exception that the emotions drive markets much more than the numbers in the short term. But as Warren said, ultimately in the long term is the weight and not the voting. So that's how it is. It has been, and that will never change.
So one thing which my senior used to say, a senior whom I consider my mentor, he used to tell me, making money is not a democratic right, which is why only one
Absolutely.
person, which is why only 1% of our population is quote unquote rich or pays taxes, right? And the reason why it's not a democratic right is because discipline is that rare, patience is that rare, and people who show discipline, exercise patience, I find it hard to believe they will not compound capital like crazy.
Absolutely.
Sajal sir, Sanket is asking your view on roofing and tile sector at this point in time. Last time we spoke about any change in view, or it's more or
Again,
less.
so roofing and building materials consumption. So roofing in general, I mean, depends on industrial roofing is a function of industrialization. Again, it's economic growth, etc. Rural area roofing is a function of, how the farm sector is performing, how the monsoon has been, and this year the monsoon has been pretty solid. But it's a challenging space, and the most of the stocks have recovered from lows, if I'm not mistaken. I mean, just quickly let me do look up on one of um, the largest player and see how the stock has performed in recent. So this is one of the largest roofing companies, and if I'm not mistaken, let me extend that. Right. So in this case, the stock recovered and now it's back to where it started, all within a matter of, I think, 6 months. So again, that is the level of randomness, right? And the reason will be, everyone will be able to analyze the reason ex post. And I know people who are very bullish on this company, assuming XYZ will happen, and when the stock was up a good 25% from the lows, they started congratulating themselves and validating this, that their thesis is finally starting to play out. From those levels, the stock is again back to where it started. So again, it's a function of how strong and sustainable the recovery is. Is it a mandatory recovery or mandatory consumption? The answer is no. So the buyer will have to have the comfort that his or her revenue stream going into the future is well protected, and the return on the capital expense, i.e. putting a roof or deploying a tile. So for example, if I'm going for a home improvement, and if I'm a salaried employee, I will have on the back of my mind, assuming I'm working in the IT industry, that there is a list being made in the HR department, right? The layoff list. And how secure is my job? What is my current savings pot looking like? And how long can I sustain without a job? Now, given that kind of a backdrop, given that kind of an uncertainty, will I go for home improvement or will I just sit on that cash? I'll probably do the latter. Common sense, right? And if you extend that to a small business where they can't reasonably predict how their business will shape 6 months out, they'll probably hold on to any unnecessary expense for now. And that is the beauty of consumption. It thrives in certainty. Unless it's a mandatory consumption, if you go for hospital treatment, come what may, you will take debt and you will go for treatment. That's one of the reasons people take debt, healthcare. So because jaan hai to jahan hai na. So mandatory consumption, I think, is one relatively safe haven, subject to valuations. Stock will do what it wants to do, but I think from a sustainability perspective, I would rather bet on mandatory consumption and the value chain participating in that mandatory consumption rather than venturing out in discretionary consumption at this point in time. Again, if the peace returns, Ukraine, Russia as an example, and the tariff war subsides, and there is a fair degree of certainty in jobs, etc., then the picture will may take a dramatic U-turn, but who knows?
Right, sir. So, Aditya, sir, you positively spoke about the cement sector, which appears to be well placed. What else we can infer? Like, if cement has to do good, what additional we can look for, and your broader views on the infra sector would be
Sure.
helpful also.
So look, cement currently is doing well because of public capex. Let's be very, very clear. Private capex has not picked up. It is public capex which is driving the entire infra spending and in turn the cement sector. What can add further fuel to fire is private capex. picking up, which again is a slave of consumption numbers, as I said, which I believe will pick up after the 8th pay commission comes into force. So maybe another year, maybe, give or take a quarter, is when we should start seeing some pickup in consumption, and then from there pick up in private capex, and from there pick up in cement. Infra, I think, should stagnate from here, because I think if you notice carefully the budgeted numbers, government has stopped sort of being over aggressive on infra spends. And I think that comes from the pocket where they have realized that they need to sort of maintain some current account deficit numbers, where the fiscal deficit numbers, where they are saying that if they further increase spend, then fiscal deficit sort of spirals out of hand, and which is why I don't see government further accelerating their capex programs, but I do see private capex coming on stream once consumption picks up, which will be about 4 quarters away.
So, sir, question to both of you. A good monsoon is not a trigger to kickstart the consumption, or it is one of the small triggers, or you can say parameters to look for?
My view, good monsoon helps, but is not the be all and end all of consumption. I think taxation is important. I think inflation is important to understand how this. So basically, consumption is a function of disposable income. Now, monsoon impacts disposable income of farming families by and large, and obviously affiliated industries, fertilizers, urea, so on and so forth, pesticides, so on and so forth. But my view is that what is more important is that we don't see significant food inflation. We see increase in wages, and we don't see further increase in taxation. In fact, going by what government just announced today, relaxation in GST rates, I would believe then disposable income will start inching up. That will drive consumption. That's my view. Sajal bhai.
No, absolutely. I think monsoons have already held, as I said, one chemical company that has never delivered numbers in last 10 years, if my memory serves me right, has came out with a blockbuster set of numbers in agrochemicals, right? And so again, that's early sign. Whether that is sustainable or not, only time will tell. But otherwise, I absolutely agree with Aditya. And they also, the one more additional variable to add is this uncertainty, right? Even if you are making money today and you're uncertain about your own future, you would rather conserve that cash and not spend it.
Right. So, Sajal sir, one question which that we recently saw the rating upgrade for India. So, what is your view? Obviously, the market is not that euphoric to take that so much positively, but again, what could be the potential consequences or
It's a
impacts going
non-event.
forward?
India doesn't require any certificate from Moody's or S&P. India is a gorilla in the making. US failed to stop India even when Pokhran happened. Clinton administration, they tried everything possible, right? So that is how they have operated always. It has always been transactional. And India is unstoppable. I mean, I tweeted this on Independence Day, right? Eve. It was 10 o'clock here in the UK. It was already 15th in India by the time I tweeted. And I'm a very staunch believer that no external force. I mean, the biggest enemy that India has at the moment is Indians living inside India, because they are non-believers. We refuse to believe on our own sort of capacity and competence. That is the unfortunate part. Other than that, I don't think any external administration, because this government is hell-bent. They will not let anyone dictate their foreign policy. And India is no inferior in terms of, look at ISRO, look at DRDO. People talk about, the capability of foreign companies. Look what we have done in the recent war. I mean, let's not forget what DRDO is all about. And these guys, the foreign powers, they know. That is why they are so afraid that, they can extrapolate. They can assign a PE on the current earnings. and they can see where India probably could be 10, 15 years out. And that is where the nervousness is coming from. They deserve to feel nervous. I think they deserve to be afraid of India. It's a rational thinking.
Yeah,
Aditya, you would like to
I
add?
think rating upgrade will help in one sense. I agree with Sajal bhai that we don't need anybody's certificate. That is true. But India has about 750 billion dollars of external debt that we have borrowed from overseas. And on that, today we will be making around, let's say, 6% or 7% dollar interest payment. That's about $50 billion in interest that we pay annually on that debt. And the rating upgrade implies that we'll be able to refinance some of that debt as and when it matures at lower rates. Because if your credit rating is higher, you are able to issue bonds at lower coupon payments and lower yields. So that $50 billion might come down over time to, let's say, $40 billion. For a country like India or economy like India, that $5-10 billion savings in interest payments is not a big deal. But, that's sort of the marginal impact I see from this earning update.
Right. Sir, one question is on 2, 3 companies, US based, I guess. Or correct me if. Yeah. So it's asking how are Eli Lilly, Novo Nordisk, and United Health from broad valuation point of view after recent correction. If you
Again, see, it's a relevant question, but again, valuation to me is a function of forward rate of change. A company that is highly valued, if the forward rate of change stays positive, and that may only gain in valuation even from those inflated levels. Whereas if the forward rate of change dips, like we saw in case of Novo, right, the bad news came after the stock corrected, that the market is shrinking. Plus, on top of it, there is a significant emerging quote-unquote pricing pressure even on the innovator side because of what Trump administration is talking about, and Eli Lilly has started endorsing them. Again, will the price parity happen by them increasing the prices in Europe? That is also one factor. Or will they only reduce prices in the US without increasing the prices in the Eurozone? Because that is one of the concerns that the administration has got. That, the same tablet is priced significantly higher in the US. So you could do many things. You could reduce the cost of that tablet in the US, or you increase slightly in Europe and reduce slightly in US to balance it out. But my sense is that the real culprit in healthcare is not the medicine itself, is the distribution, the marketing, and the middlemen. They create a lot of problem, and the leakage is happening. The benefits manager and the middleman level and the distribution. That's where the inefficiencies are. Look at the hospitals in the US. For a standard procedure, different hospitals are charging different. So pregnancy as an example, delivering a baby should be, it's a fairly standard procedure. But different hospitals charged, random amount of money. So I think there are serious inefficiencies in the system, and 5 to 10% of people are eating disproportionately into the healthcare. So 50-60% of the money spent is going into probably the 10% pool of people. So I'm not too sure, putting pressure on the innovators to reduce the drug prices will solve the healthcare challenges that the US. I don't think it will move the needle ultimately. There has to be other mechanisms, i.e. attacking the middleman, simplifying the procurement, going for a single, just like, the Europe does or UK does. A single body should be procuring medicines at a discount. Those kind of mechanisms have to be deployed. Whether US has got the spine and the intent to do that, or they are just happy making noises and creating news bites. Time will tell. I'm not very optimistic, but yeah, there are serious headwinds emerging out of innovators. So any company that is serving the innovators, I mean, again, may be challenged in the sense that if their percentage of what they're making is a significant portion of innovators' cost. To me, APIs are, and I've explained this in greater detail, if something is 2% of your total expense. Even if you end up paying a 25%, 30% or 100% tariff, that 2% will become 4%. Not gonna be a game changer for you. But if something is 30%, 40% of your total overall cost base, you will be very price sensitive. That's all I would like to say. Aditya, anything to add? You must be having some views, right? Here in the drug pricing and the negative chatter that is emerging.
No, drug pricing, are we talking about US or are we talking
Yeah,
about India?
US in general. I mean, India is well documented. India is not something that has happened all of a sudden. I mean, NLEM and DPCO have been well established mechanisms for
Yeah, yeah,
decades now.
yeah. No, so look, I think the problem with the US ecosystem of pharmaceuticals is, as you said, the middlemen, right? The HMOs, the GPOs, and then you have your pharmacy chains and your wholesalers. So it's a very and the top of that the
Insurance.
insurers,
Yeah.
insurance on top of that. So if you add all of that, I mean, the supply chain is so complicated, and there are so many various stakeholders with their vested interest. Ultimately, who ends up getting screwed is the consumer, right? So I think lower drug prices in US is definitely a possibility, but that would require structural changes in the supply chain. And to my mind, it won't happen, because if, for those who don't know this, in the US, the most amount of money spent in lobbying the politicians is by financial services, followed by pharmaceuticals.
All right. So, Aditya, you spoke about logistic as one pocket where you are
Yeah.
looking at. So, my question is, despite having a very huge opportunity, why the sector as a whole is not getting those level of valuations? I mean, are there any thing to look for broadly? Because it can happen that certain companies within the sector are doing good by all means, and the sector is not getting. So, what is your reading
Yeah,
on
I
that?
think, look, logistics has two components to it. एक तो international है, एक domestic है, right? I think international logistics is more global trade driven, and if the anti-China sentiment were to play out, then India's global trade will definitely go up as a market share, right? So the international logistics में तो वहां पैसा बनेगा. Domestic logistics again comes down to consumption linked, right? So if you can find companies which have decent exposure to both domestic and international, I think that is where your international will protect you in the near term, and domestic, whenever the consumption growth happens, there will be that additional fillip to numbers from uh, 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 eventually consumption growth. Why these companies have not been rewarded yet? Because the consumption part hasn't really fired. So it's just the international trade which is driving growth for them. And with that growth on, the base doesn't look very high. And if the growth is not high, the market today is not going to value you very richly. I think that is where the disparity is.
All right. So, Sajal sir, if I were to ask you, like, maybe
Prince,
on a scale
I
of
need
one,
to take your
yep,
leave, yeah. Is it okay if I leave now and you and Sajal carry on? Is that fine?
And I'm not sure how
yeah,
much
yeah,
value I
sir,
can.
Sajal sir, how good we are on time? I mean, we are almost
Yeah, I
2 hours.
mean,
I mean,
let's.
sorry, I didn't ask you
I
it.
mean, it's not much point me just answering all the questions because we need Aditya's view as well. So maybe we could take last remaining one or two questions and call it a day.
Perfect. One question from my side, and maybe one question you each can ask in case there are any. Yeah. So, Sajal sir, I mean, if I were to ask you, like, on a scale of 1 to 10, where are we in the cycle? I mean, let me simplify the question broadly, although it is company specific when it comes to the SIP amount, but broadly on a portfolio level, if I were to deploy, say, on a scale of 1 to 10, where you believe where we are?
So what is one and what is 10?
One is, I mean, you are deploying less money, and 10 is like you are going full on.
Somewhere in the middle, I would say. Again, for me, it's always case by case. So I have seldom looked at, how the broader market is because I want to pick the business cycle. For me, market cycle, economic cycle are less important, and the business cycle is far more important. At least 70-80% of the contribution comes from the business cycle. So I look at where the business cycle is today, and if the business cycle hasn't matured, and there is every evidence of money to be made, I would wait for, even 5%, 10% kind of a dip in those stories to add to my allocation. Um, but other than that, I think I'm reasonably cautious. Definitely, it's not a 10 for me, but it's also not a 1. It's kind of somewhere at average. So, a number between 4 and 6, I would say, because today is not the time to go full steam across the board. It may be time to go full steam or full throttle ahead on specific stories. Uh, but if I want to take an aggregate view, I agree with what Aditya said in the beginning. The market as a whole is not cheap, was reasonably valued and marginally overvalued. So whether it's a function of time correction, or a correction, price correction happens, and we find Nifty correcting 10%, 15%, and then valuations become reasonable all over again. We don't know which way the market will go, but on an aggregate basis, market is not cheap.
Thanks. So Aditya bhai, being a fund manager, client communication is something which is very essential and important, right? So I would like to know from you at this point in time, what are the main points which you want to highlight? I mean, obviously when the markets are uncertain or maybe confusing, people are, kind of reserved to deploy fresh
Yeah.
money. So what would be your advice, or maybe broadly, if you can tell how you have been doing tackling this kind of scenarios with your clients, maybe?
Yeah. So what we are essentially doing, Prince, at this point is we are trying to tell clients to be patient. So those who have invested and made a lot of money with us over the past 2, 3 years or 5 years, we have told them to sit tight, not to sort of top up on their accounts, not to give us more capital. We'll ask for it when we need it. Those who were looking to deploy fresh capital, we had told them that, look, if you have 100 rupees to invest, give us 50 now. Keep 50 rupees dry powder ready. We will ask for that 50 rupees as and when we feel time is appropriate. Now, the reason why we have taken that stance is while the overall market looks very uncertain and, in pockets extremely richly valued, we are still able to identify opportunities which are reasonably valued, good earning growth, great cash flow, good business model. So we want to deploy capital also, but we also want to have some dry powder ready just in case there was a broader correction in the market. So we are sort of following a barbell approach. We were saying if you have 100 to invest, give us 50, keep 50 with you. We'll ask for it when we need it. And for guys who has already invested, we are saying don't give us more capital now. Keep it with you. We'll ask you for it when we need it.
Perfect. So quick closing remarks from both of you, and that would be, I think, we call it a
Sure.
day.
So thanks guys for listening in. Again, the disclaimer applies. Whatever names I took, if I took any, was for educational purposes. Do your own diligence. And it was a lovely interaction. Very happy to look forward to speak to you guys again in the near future.
Yeah. And thank you, Aditya, and +1 on that disclaimer from my side as well. Thank you.
Good night, guys.